Hi, everybody. This is Greg Gossa from Gossa Trading and Mentoring, and today is Saturday, November 22nd, 2025. I hope you are doing well. I hope you are having a nice weekend, and I appreciate you coming to my weekend review podcast. I hope you're going to learn something today and find it valuable. So, wow, what a week we had last week in the markets. Big sell off on Thursday. It's been volatile, so I hope you're staying safe out there, being patient, waiting for your setups. And like I just said, I hope this podcast is going to be helpful for you. I'm going to point out, in addition to my trades last week, we're going to later on in the podcast talk a little bit about just the markets in general, kind of some of the technical levels. So the format for today is, first of all, we are going to run the U.S. legal disclaimer. Secondly, we're going to come back. We're going to look at all the trades that I made last week, all the entries, all the exits. We're going to talk about when I entered the trades, why I entered the trade, what the setups were, what the confluence of signals were of why I took the trade. We're going to talk about how I position size based upon the current current volatility of the market. We're going to talk about how I place or where I place my emergency stops, where I place my end of bar stops, how I take partial profits if the markets move my way, and then ultimately how I get out of the trade either to the upside or to the downside. So I did have some stops last week, like a lot of people did, right? Because of the market, but also had some good trades. So all in all, I was lucky to have and felt fortunate enough to have a good mix of positions last week that kept me green on the week, even through this volatile week. So after we talk about all the trades I made last week, again, when I entered, why I entered, and how I am going to manage the trades going forward. We're going to spend a little time on trader psychology. Always the most important skill in trading is the ability to create a plan and then to follow the plan. You can have the best plan in the world, but if you don't follow it, what's the use, right? So it's in my experience, I've been trading for over 30 years. Every day that goes by, I'm more convinced that you have to basically have a mechanical approach to trading so that you have a process to follow so that you don't just make quick emotional decisions on the spur of the moment, right? And so, but all in all, the process that you have has to allow for a potential big gain and a small loss, right? Easy to say, but you have to structure your trades to do that. And so I'll show you today how I attempt to do that. And you're going to have losing trades in trading, there's no doubt. But the key is keeping them small. You have to be very impatient with your losers and you have to be very patient with your winners. Unfortunately, most traders do the opposite. They're very patient with their losers and they're very impatient with their winner. So this all comes back to trading psychology. We'll talk a little bit about it. Hopefully it's going to be helpful for you. It's always helpful for me to teach it. So I hope it's helpful for you to listen to it and incorporate it into your trading. After that, I have gone down through my watch list. I do that every Friday night, and I'm looking for potential trades for the upcoming week. And so I go through each market that I have in my watch list one by one, go through, and I look for potential setups that are close next week that have confluences, combination of levels of support or resistance that are lining up. They're not there yet. If they were already there and triggered, I probably would have already taken the trade. But these are getting pretty close. And does it mean if they trigger that they're going to be a successful, profitable trade? Absolutely not. But the more you're patient, the more you wait for a confluence combination of indicators, levels lining up, just simply the more likely it is that you are going to have a winning trade. And a winning trade potentially with large upside. And if it's a losing trade, if the trade's structured correctly, then yes, you can be wrong. But like I just mentioned, you can likely be wrong small. And that's the whole key. That's the whole key of trading. So I have gone down through my watch list. I've identified some things that next week are close, potentially could happen. And so hopefully it'll give you a good idea of how I look at trading and how I monitor trades that are close to being close to triggering. And you know, it's nice to do it on the weekend too, without, you know, the market's closed, things are calm, and I can just go through and go, okay, these are the ones that I'm going to concentrate on next week, and so that I don't miss them. That's kind of a big key, being organized and having your trades there in the quiet, looking for the trades in the quiet. And so you just have a nice list to look at that when next week you go, oh, this one triggered, and then I can decide whether or not to take the trade. So, okay, let's run this U.S. legal disclaimer, get that out of the way, and then we'll come back and we'll get started. So hang tight, please.
This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. Thank you so much.
All right, so we have a lot of trades to get through. I still have a lot of open trades that I'm managing, and then, like I said, I did get stopped out of some trades last week, and we'll go over all those. And I did get stopped out of some trades to the upside. We'll also go over those. But let's go through the open positions to begin with. Okay, this is USO. This is oil. And this particular trade I entered here on October 20th at 67.81. So why did I enter here? Well, this particular trade was a order block. You can see this green box in here. So this is an order block trade, but let's go back in the past and take a look and see why this is an order block. So if we go all the way back here, this order block formed on May 30th, 2025. So what is an order block? So an order block, you have to have a certain price action that will define an order block. And an order block starts with a swing low. Now a swing low, here's the swing low. A swing low is just a bar that has a higher low to the left. You can see the low to the left was higher than this low, and then a higher low to the right. That makes a swing low. So we have a swing low. Now, after you have a swing low, you have to have a swing high. Well, a swing high is just the opposite. It has a lower high to the left and a lower high to the right. Makes sense? So here's a swing low, lower high to the left, higher low to the left, higher low to the right. Check. Here's a swing high, lower high to the left, lower high to the right. Check. So swing low, swing high. Then we need another swing low. This is swing low, lower high to the left, lower high to the right. But the key is this second swing low has to be lower than the first swing low. So we have a swing low, a swing high, a lower swing low. Got it? Swing low, swing high, lower swing low. Now, once that happens, we need to key off of the swing high. Remember we had the swing high, swing low, swing high, swing low. Well, now this swing high is an important level. So let me just put a line here. Swing low, swing high, lower swing low, and then here, this is the important move right here, because now this bar went above the swing high. So swing low, swing high, lower swing low. Now this bar here took out the swing high. And why that's important is that once that happens, once that setup, swing low, swing high, lower swing low, and then the market taking out that swing high, this changes market structure to the upside, okay? And once you change market structure to the upside, then it's very easy to find and define your order block. Your order block is simply now the lowest closing bar prior to market structure change. As soon as you take out that swing high, you've changed market structure. And take a look. As soon as you change market structure, look what happened to the market. Pretty cool, right? So swing low, swing high, lower swing low, market structure change. Once you change market structure to the upside, you look for the lowest closing bar before the market structure change. This is here. The high and the low of this bar is the order block. And what I do is I move that order block all the way into the future. Now, let's go here to the very highs. Okay. In hindsight, if you look back at that order block, was smart money buying here? In hindsight, when you're up here and you look back to that order block, was that smart money buying? Clearly it was. They bought way down here and now it's up here. Okay, so in hindsight 2020, that was a smart money area. So the idea with order blocks is that once you have the swing low, swing high, lower swing low market structure change, and you know this is the smart money area, I take that smart money area and I bring it into the future. So in the future, if we come back to that smart money area, more times than not, you will get a bounce there because it was smart money. Does it have to be smart money every time it comes here? No, things can change. It can fail, but more times than not, after you have a swing low, swing high, lower swing low, market structure change, and then you pull back to the smart money area, it bounces again. Okay, so anyway, that's the explanation of why I have this green bar here. So we brought this green bar into the future, never got back to it until here. This is months later. These order blocks tend to have memories. So you can see when the market came back and rejected the top of the order block, and by rejection, what I mean is you can see we were coming back down to the smart money area or the order block. Here we gap down into the order block, but then we closed above it. That is a rejection of the top of the order block. So you can take trades on order blocks with rejections of the high of the order block or the rejection of the low of the order block or some kind of level or moving average inside the order block. But this is why I took the trade here on this day at 67.81 because it finally came down and rejected the order block, right? And so it took a lot of patience to wait and wait and wait until I got the legit signal of rejecting the order block. Okay, so I entered here 1020 at 67.81. Okay, now as soon as I have my signal here on any trade, right, then I have to decide how many shares am I going to buy. It's a key question, and it has to do with two things. It has to do with how much money is in my trading account, number one, and number two, what is the value of the 2 ATR? ATR means average true range. What is this market expected to move in any one day? That's the 1 ATR. Well, I double that, and this is my value, 2 ATRs. So as soon as I reject the top of the order block, I say, okay, how many shares am I going to buy? And again, how much do I have in my trading account, and where's the value of the 2 ATR? So let's just say I have $100,000 in my trading account. All I do is I take 1% of that. 1% of 100,000 is $1,000. If I have $50,000, 1% is 500. If I have $1 million, 1% is 10,000, right? So it works for any amount. So again, let's just say I'm using $100,000, 1% is $1,000. Next step is I take a look at what is the value of the 2 ATR. It's 282. So I take the $1,000, I divide it by 282, and that tells me to buy 354.6 shares. So I'll just round it up to $355. Now, this week is a very good example of how and why using the 2 ATR to figure out how many shares you're going to buy is so important, because when the volatility is greater, this number is going to be higher. And if you divide your $1,000 by a higher number, you're going to get fewer amount of shares, which is exactly the point. When volatility is higher, you should be buying fewer shares because things are moving bigger, right? So you need to position size smaller. When volatility is low, this number is going to be lower, and therefore the amount of shares you're going to buy is higher. So it's very key. Not a lot of traders do this. They buy the same amount, but depending, regardless of what the volatility is. So the volatility has increased dramatically, and so I need to buy fewer amount of shares. And this simple formula does it all. Okay, so 1% of 100,000 is 1,000 divided by the value of the 2 ATR. Boom, 355 shares is what I'm going to buy. So first thing I do, I see the entry. I have the rejection of the high of the top of the order block. I do the math. I buy 355 shares at 67.81. Now the first thing I do after that, I have to take my entry price minus the value of the 2 ATR that we just used in the equation, and I put a red line here below. So the red line is exactly $2.82 below my entry. This is called my emergency stop. So if I have 355 shares and it moves down $2.82, how much have I lost? I've lost $1,000 or 1% of my trading account. That's the most that I want to lose, allow myself to lose on a trade, is 1%. If you lose 1%, okay, it's not fun, but you can recover from this. The problem is when you lose 8%, 10%, 12%, it's very difficult to recover. So this is the maximum I'm setting, or I'm creating in this setup, that if it moves down, hits my emergency stop, I'm going to lose 1% of the account. Okay. So the good news is, and this does happen, right? I've shown many times where I've hit an emergency stop. But the good news is this tends to only happen about 5% of the time. The other 95% of the time, when I have a losing trade, it's going to be much less than 1%, because it's going to be my end of bar stop, and my end of bar stop is almost always closer to my entry price than my emergency stop. So on this particular trade, and I trade different trading approaches, so my end of bar stop is going to be different on different setups. But on this particular trade, why did I take the trade? I took the trade because it rejected the top of the order block. My end of bar stop on this trade is if it closes below the low of the order block. The low of the order block is 66.03. Okay, so I have the emergency stop down here, and if I hit that, it's 1%. However, if after I bought it, if the very next day it had just closed below the low of the order block, I simply would have got out. Would it have been a loss? Yes. Would it have been 1%? No, it would have been much less, because you can see the stop is much closer to my entry than my emergency stop. Okay, so my emergency stop, 2 ATRs below my entry. My end of bar stop on this particular trade, a close below the low of the order block. Okay, so after I've entered the trade, I position sized, bought the correct amount, I set my emergency stop 2 ATRs below. I know where my end of bar stop is, close below the low of the order block. The next thing I do is I look to the value of the 1.5 ATR. The 1.5 ATR is $2.12. This changes every day, okay, but right now it's $2.12. So once I enter the trade, I looked for the value of the 1.5 ATR, and I add that above my entry price. I take my entry price plus whatever the value of the 1.5 ATR is above. This becomes my trailing stop level. Trailing stop level, once I get to the, if I get there, it doesn't mean I do anything. It just means that now I go into what is called trailing stop mode. So in general, with trading, if you enter a trade and it starts moving your way, right? If it moves a certain amount from where you entered, then you want to tighten up your stops, right? You want to go into kind of a trailing stop level, right? You don't want to give all those profits back. And so that's what happens, and this is why I use the 1.5 ATR trailing stop level. And all that means is now if I get to trailing stop level in the future, if I have a close below a previous bar's low, I'm going to sell half of my position. I'm going to keep half, but I'm going to sell half of my position. And what that does is that just by default tightens everything up. It moves everything up by half, right? Because I want to tighten up those stops. Well, selling half does that by default. Okay. So now everything I've talked about so far, the emergency stop, the end of bar stop, going into trailing stop level, these are all defensive moves. In other words, if the market goes against me, it tells me I have to do something in a defensive way. Okay. If it hits my emergency stop, I have to get out. If I end a bar stop, I have to get out. If I have a close below previous bar's low after reaching trailing stop level, I have to get out of half, right? But these are all defensive moves. Well, I also want to play offense in my trading, right? Just like any sports team. Yeah, you have to play defense, but you have to have an offense too. Well, in trading, my offense is taking partial profits if it moves a certain amount each day from the previous day's close. Not all, but a portion. So I'll give you an example here because I'm still in this trade. All I do is I take the closing price of the day. Right now, the closing price is 69.30. Okay, so 69.30. Now I look for the value of the 0.45 ATR. The 0.45 is 63 cents. This changes every day, but right now it's 63 cents. So I take the closing price plus the 63 cents. My first profit target for Monday is 69.93. Now the question is, how much do I take there? It's very easy. 10% of however many shares I have going into the day. If I have 100 shares, 10. That's it. If I have 90 shares, 9 at that first. If I have 50 shares, 5, right? But I don't do it just once. I do it 3 times. So I look for the first profit target, which is again the closing price plus the 0.45. We just did that. My first profit target for Monday, 69.93. Then I just take 69.93, the first profit target, and I add the 0.63 to it again, plus 0.63. My second profit target for Monday is 70.56. Again, if I get to the second profit target, I just sell another 10% of however many I went into the day. Okay, and I do it one more time. I take the second profit target, 7.56, plus 0.63. My third profit target for Monday is 71.19. And if I went into if I went into the trade with 100 shares and I hit all 3 profit targets, I take off 10, 10, and 10. If I go into the trade with 500 shares, I take off 50, 50, and 50. And some days you'll hit 1 profit target. Some days you'll hit 2. If you have a really good day, you'll hit 3. If the stock goes down the next day, you hit 0, right? But it's important to take off a little bit. In my opinion, it's important to take off a little bit of gains every day if the market gives you something, right? Just makes sense. You need to be balanced, offense and defense. Okay, so now that we've got through kind of most of the building blocks of the trade and the specifics, let's just kind of start over on the trade and we'll follow it through and we'll see how it did. So why did I enter the trade? 10, 20, 25, I entered at 67.81. Why? The rejection of the high of the order block, the green box, okay? So I position size, I enter, I place my emergency stop 2 ATRs below. My end of bar stops, a close below the low of the order block. My trailing stop level is 1.5 ATRs above, and away we go. The next day, did it go up? It did. Did I hit profit target? I certainly did. Okay. Next day, I redo my profit targets, and boom. Next day, up again. Nice. I hit multiple profit targets. I think I hit 2 on this day. In addition to taking the profit targets there, I also got to trailing stop level, right? I got to the 1.5 ATR trailing stop level. Do I do anything? No. It just means that now in the future, if I have a close below a previous bar's low, I'm going to get out of half. Okay. Next day, boom, up again. I think I hit 3 profit targets on this day, right? So again, I have been scaling out with these partial profits all the way up because the market gave it to me, right? Okay. Next day is down. Next day, nothing. Next day here, it's our first close below a previous bar's low. After reaching trailing stop level, what do? I took off half of the remaining shares that I had. Remember, I have fewer shares here than I did here because I have been scaling out and taking partial profits, right? So I have fewer shares, but here we have our first close below a previous bar's low after reaching trailing stop level. I locked in uh, uh, half for a gain of 4.97%. Okay, but I also kept half. So going forward, next day up, hit a profit target. Next day up, hit a profit target. Then we had a move down, no profit targets. Then we had a few days up where I did hit a profit target here. And then we moved down and then down. And then we, boom, we rallied. Am I glad based upon where we are now that I sold into some of that strength? Yes. Another profit target here. Yes. And then the last few days, we've just been down. So the remaining shares that I have are still up. Oops, what did I do? The remaining shares I have on this particular trade are still up 2.11%. And I will hold these and I will continue to scale out if it moves up. However, if it moves down and closes below the low of this order block, what am I going to do? I'm going to get out, right? That's it. But in hindsight now, right, enter the trade here. Am I glad that I sold partial profits when it was up here? Well, of course. Am I glad that I sold half of the entire position here when I went into trailing stop mode and I had to close below the previous bar's low? Of course, obviously, because we're lower now, right? So I sold a lot of stuff higher up here, up here. So that's the importance, at least in my opinion, of taking partial profits and taking a little bit, not all, but a little bit when the market gives it to you. So the remaining shares I have on USO up 2.11%. MO, okay. MO is Altria. Has not been a super exciting trade, but it has held its value in this volatile week, so I'm grateful for that. So I entered MO here on the 3rd of November. Why? Again, order block. Take a look. Here's the order block from the past. This one was uh, a rejection of the low of the order block. The one that I just showed you on oil was rejection of the high of the order block, right? But this one's a rejection of the low of the order block. During the day, we went below the low and we closed back in, right? I always base my entries based upon the close. And when in trader psychology, we're going to talk about why that is, but I always base everything on the closing price. So on this particular day, we were below the low of the order block, but yet it was strong enough to close back in it. So I entered 56.63. I position sized. I placed my emergency stop how far below? 2 ATRs. Where's my end of bar stop? Simply a close below the low of that order block. You see how close I am to that to begin with? If the next day it had just closed below and closed under, okay, I'd have been out probably for a small loss, but that's it. But it didn't, right? So emergency stop 2 ATRs below, close below the low of the order block is my end of bar stop. As always, I placed my 1.5 ATR trailing stop level above my entry, and away we go. Next day, up. Great. Next day, up, profit target. Next day, down. Next day, up, profit target. Next day, kind of down. Next day, up, profit target. But on this particular day, we got to trailing stop level. Does it mean that I do anything immediately? No. All it means is that now in the future, if I have a close below a previous bar's low, I will get out of half. That happened here on the 13th. This is the first closing bar below the previous bar's low. After reaching trailing stop level, I took off half the position for a gain of 2.02%. Okay. Again, my stop is still on the balance. My stop is still a close below the low of the order block. Then we move up a little bit, not enough for a profit target, down a little bit. Here on the 18th, we move up nicely, took some profits into that strength. And then the last few days has just kind of been going nowhere. But based upon last week, going nowhere was a win, right? So the remaining shares that I have on this particular trade, up 2.68%. All right, next trade. VIX. All right, this has been a big trade. Okay, so I did enter VIX here on 11/12/2025. Why did I enter? Well, clearly you see the green box. The green box is an order block from the past. And on the day that I took the trade, it rejected the bottom of the order block, meaning that at one point during the day it was below it and then it closed above it. So I entered at 32.89. Okay. I position size. I place my emergency stop 2 ATRs below as always. My end of bar stop is very, very close. Just in the future, if it closes below the low of the order block, I get out. So again, it's the structure of the trade. I always have the 2 ATR emergency stop, but you see how close I am to my end of bar stop, right? Which gives me very limited downside with theoretically unlimited upside, right? And so that's how we should structure all of our trades. They don't always work out, but you have to at least structure them that way, okay? So entered here, 32.89, emergency stop 2 ATRs below, end of bar stop closed below the low of the order block, place my 1.5 ATR trailing stop level above, and away we go. Next bar, boom, up. Multiple profit targets into that strength. And that very next day, I got to trailing stop level. Next day, up at some point during the day was up, took some profits into that strength. Okay. Next day, up again, took some profits into that strength. Next day, up again, took some profits into that strength. Now we're in trailing stop mode, but we have not had a close below previous bar's low. On Thursday, when we had the big move down in the market, initially it gapped way up, so VIX was way down. But again, I make my decisions based upon the closing price, and it had that huge reversal, and I hit multiple profit targets to the upside. Okay, now want to take you to that particular day. On this particular day, the RSI got to 66.96. So I have a rule. If we ever get 65 RSI or higher, now in the future, if I have a close below the 5 EMA, that's where I completely exit the trade. Okay. So on on Thursday, yes, we got 65 or higher. So now that 5 EMA comes into play. Well, here it is. You see how we just closed above the 5 EMA? Had it closed below, I would have exited, but it closed above. That kept me in the trade. All right. So the remaining shares that I have on VIX, up 12.06%. This is a very good example of having a very good risk to reward ratio, having the potential to be very, if I'm wrong, to be wrong very small, but the potential to have a big up trade. And you can see that's exactly what happened. All right. So we'll see what happens Monday. If Monday the market's up, then it will probably close below the 5 EMA and I'll be out of the trade. Right. If it keeps going up, I'll just continue to take partial profits if the market gives them to me. So The remaining shares on VIX up 12.06%. I was very fortunate to have this trade because, the market was down so much. So it was kind of a nice hedge to the market in general. TMC. All right, TMC, let's go back in time. There's an order block. You can see what formed the order block. Swing low, swing high, lower swing low, market structure change. Oh, no, excuse me. Yeah, swing low, swing high, lower swing low, market structure change, lowest bar closes this, bringing it into the future. You can see the market just went up and up and up and up and up. So this defines this in hindsight as smart money. You bring the smart money area into present day. And if we zoom out on this chart, look, smart money went up here. Obviously, smart money came back down to the smart money area. Did it hold and go up again? Certainly did. And then in the future, we got here to the smart money area again, and that is why I bought. I bought here. Sorry, my mouse gave me a little trouble here. I bought here on the 17th of November at 488 with rejection of the 200-day moving average. Didn't quite get to the order block, but the 200 was right there. So that's a combination of a deep dip buy, bounce off the 200 at the top of the order block. So I entered a 488. I placed my emergency stop 2 ATRs below. My end of bar stop on this particular trade is very close. It's just now a close below this 200-day moving average. So using a 200, a 250, a 300, these are deep dip buy levels, but I like the combination. I always love the combination of a major moving average like the 200, 250, or 300 being in or near the order block, okay? So I entered 488, placed my emergency stop 2 ATRs below. My end of bar stop is closed below the 200-day moving average. I placed my 1.5 ATR trailing stop level above, and here we go. Took right off, multiple profit targets. I think I hit 3 profit targets that next day. Remember, that's 30% that I took off, right? And then the next day up again, biggies, where I hit multiple profit targets before it reversed, right? You see the benefit there? Sometimes you have these big gap ups, but by the end of the day, you're down. Well, setting those limit orders the day before, I sold at least 2 profit targets on this day before it reversed, okay? Now, I did get to trailing stop level here. So in the future, if we have a close below previous bar's low, get out of half. Well, that happened on Thursday. We had our first close below a previous bar's low. I had to exit half. But remember, during the day before the big reversal, I locked in another 2 profit targets. So can you see how important those intraday profit targets are, right? Because it gapped up, went zooming up where it took out 2 profit targets, but then it did close below a previous bar's low after reaching trailing stop level, and I sold half and locked in a gain of 6.35%. And then it didn't do much on Friday, so the remaining shares that I have based upon Friday's close up 5.61%. So Thursday I locked in half for a gain of 6.35%, and the remaining shares up 5.61%. Shopify. Okay, Shopify, you see an order block here, right? Now, you see this green line inside the order block. So what is that all about? Well, I really love when there's a 200, 250, 300, or really any moving average inside the order block that I can key off of that level for rejection. But if we go back to what started this order block, and again, let's just do a recap. What's an order block? Swing low, swing high, lower swing low, market structure change. Once you change market structure to the upside, the lowest closing bar is your order block, the high and the low. Bring that into the future. Well, on the day that this order block formed, it's a big up bar. If you have a bar that's a big up bar that closes near the high, then the halfway of that bar from a Fibonacci standpoint, there will be support. If you have a big up bar and it comes back in the future to halfway, that's generally where you'll find support, and oftentimes it will bounce there. So I know this, I see this bar, I take the halfway of this big up bar and I bring it into the future inside the order block. So this was months and months ago, right? And again, Shopify, when we're up here in hindsight, was this order block smart money? Yeah, of course. Here you're at 170, people were buying this at 136. So yes, it's clear that this order block was smart money. Will it be smart money again if price gets down there? Maybe, maybe not. We'll see, right? But again, I have the big up bar halfway. That's the green line. So we go into the future. Okay, it came down, 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 getting close to the smart money area. Look at that, everybody. Remember the line that I drew, the halfway line that I drew? Almost to the penny. Almost literally to the penny. That halfway mark that was months ago, the market remembered that, at least for the time being. So I was looking for a rejection of that level, of that green line inside the order block, 136. Well, it certainly, to the penny, and then closed above the order block. So it's legit. So it rejected the halfway of the mark that I put in 136 and rejected the high of the order block. I took the trade, 140.47. I placed my emergency stop 2 ATRs below. Oops, sorry. My end of bar stop on this particular trade is not the bottom of the order block. It's just the level that I put in, the halfway mark here, right? So I'm not going to wait for it to close all the way below the order block. I'm just waiting for it to close below that halfway mark that I put at 136, the green line, right? To keep my end of bar stop closer, right? This is a lot closer than the bottom of the order block. Okay, so I entered 140.47. I placed my trailing stop level 1.5 ATRs above. Next day, took off, profit target. Great. Next day, multiple profit targets on that huge gap up. Great. Before it reversed, but you can see there's value, right? That I took multiple profit targets at the open and reduced my position size before it came down. Okay. And then again, up on Friday, I hit another profit target. So the remaining shares that I have, and we're in trailing stop level, but we have not had a close below previous bar's low, so I have not taken off half. So the remaining shares are up 5.04%. Pretty good, right? Pretty good for last week, for sure. FXY. All right, FXY is the Japanese yen. I bought this here on Thursday. Why? Rejection of the low of the order block. There's an order block from the past. I was waiting for it to come back down to either reject the high or the low. Here it came in the order block, but didn't reject the high or the high of the order block. But on Thursday, we rejected the low of the order block. So I entered 58.33. I placed my emergency stop, as always, 2 ATRs below. My end of bar stop is simply a close below the low of the order block. Look, we're almost at the low of the order block right now, or on the day that I bought it. So the next day, had it just closed even 1 penny below there, I'm just out. Okay, fine. Took a shot at it, didn't work. Probably a small loss with a potential big upside. Well, that's exactly what happened. Placed my 1.5 ATR trailing stop level above, and look at that. Boom. Next day, after rejecting the bottom of the order block, took off. I hit 3 profit targets on Friday. Took 30% of the trade off on Friday, and we got to trailing stop mode. So all that means now is in the future, if I have a close below a previous bar's low, I will exit half of the position And currently, this particular trade up 0.75%, which is a lot on a currency in one day. MasterCard. Okay, MasterCard is a good example of two strategies working together. Deep dip buy strategy, order block strategy. Okay. On the 19th, we rejected the bottom of the order block. You can see we went below the order block and then closed above it. Okay. I entered at 530.38. Okay. But there's two things going on here. Yes, we rejected the bottom of the order block. That is a legitimate entry. But, well, here, let me take you through this. I'll show you. The day before was a legitimate entry as well. It rejected the bottom of the order block. But look at the RSI. The RSI was 28.78. Okay. So from a deep dip buy perspective, which I use and I teach, deep dip buys. Deep dip buys include 200s, 250, 300 moving averages, but they also include an under 30, over 30. If you go under 30 and over 30, that by itself is a legitimate entry. But you can see on this particular day, we did not close above 30 RSI. But the next day, look, we closed at 31.61. So that is a close under, close over 30 RSI. That by itself is a legitimate entry. And we also rejected the low of the order block. Okay. So those are two primary strong signals that I use and I teach. Rejection of the bottom of the order block, rejection of the 30 RSI. So I entered at 530.38. Okay, I position size. I place my emergency stop 2 ATRs below as always. My end of bar stop is simply a close below the low of the order block or the 30 RSI, whichever one came first, right? Because we closed under 30, closed over 30. When I got into the trade, I said, if it closed below the order block, that's good for me. The next day, went up, took off a profit target, obviously, right? And then on Friday, up big. I hit multiple profit targets on Friday, selling into the strength. Now, we are not at trailing stop level yet. So if I had a close below a previous bar's low now, I would not have to take half. But if we continue up and get to trailing stop level, then if I have a close below, I will get out of half, right? So this trade's doing very well, up 1.86%, which, you know, based upon last week, really glad to have something that was up. Okay, so doing pretty well, up 1.86%. And again, combination, deep dip buy, order block. Okay, Microsoft. I did take Microsoft on Friday, yesterday. I entered Microsoft. Why? Because we rejected the bottom of this order block. During the day, we were below, we closed back in. Okay, now, again, this is legit. It's a rejection of the bottom of the order block. I was really hoping that we would, in addition to rejecting the bottom of the order block, we would have also closed above the 30 RSI. But we didn't. We closed at 28.44. So it's still fine. It rejected the bottom of the order block. It's a very good risk to reward ratio. If Friday it literally closes 1 penny under that order block, I'm out. But, you know, in a perfect world, if we go up on Monday, this will move the RSI above 30, and that by itself will bring in other buyers. It will bring in other under 30, over 30 buyers. So we'll see what happens. So on break even on this trade, I bought it at 472.10. My stop, my end of bar stop is a close below the low of the order block. You see the orange line up here. What's that? It's my trailing stop level. If and when we get there, then I'll go into trailing stop mode. So Microsoft, break even, just took the trade on Friday with the rejection of the low of the order block. Okay, so those are all the open trades. Just we'll do a quick recap. USO, the remaining shares up 2.11%. Altria, the remaining shares up 2.68%. VIX, the remaining shares up 12.06%. TMC, the remaining shares up 5.61%. Shopify, the remaining shares up 5.04%. FXY, the remaining shares up 0.75%. MasterCard, the remaining shares up 1.86%. And Microsoft, break even because I just took the trade. Okay, so now let's go to the trades that I closed out last week. And let's start with RBLX, Roblox. So I entered RBLX on the 14th at 102.11. Why? Rejection of the bottom of the order block. We also had a V1. A V1 consists of two bars, bar 1, bar 2. Bar 2 goes under bar 1's low and then closes above bar 1's close. That is not a primary signal, but it's an additional signal to the rejection of the bottom of the order block. Another reason I took the trade. Okay, so I entered here 102.11. I placed my emergency stop 2 ATRs below my end of bar stop, simply a close below the low of the order block. The next day it held. The next day it held. And then what happened here on Wednesday? It was the first, on Wednesday, we closed below the order block. That's my stop. I have to get out. I did get out for a loss of 4.79%. Now, was it fun taking a loss? No, of course not. It never is. But am I glad now that I took the loss? We've gone down 2 days after that. Of course, right? So when you have your losses, don't question it, just get out. Yeah, a lot of time next day it goes up. You're like, dang, I shouldn't have taken the loss. But I tell you, it's a good feeling when you take your loss and it continues to go down. You're like, oh, that was the right move. So I did have to get out of RBLX for a loss of 4.79% because it closed below the low of the order block. NVIDIA. Okay, I took NVIDIA here on the 7th of November. Why? Because we rejected the high of the order block, and we also rejected the 50-day moving average, the green line, or excuse me, the gray line. So I like to take trades where you have where you reject a moving average inside the order block, because now my stop doesn't have to be a close below the low of the order block. It's just a close below the 50-day moving average. So I took the trade here, 188.20. My emergency stop is 2 ATRs below. My end of bar stop is just a close below the 50-day moving average. The next day, boom, takes off big, hit multiple profit targets into that strength, thankfully, right? And we also got to trailing stop level. The very next day, we have our first close below a previous bar's low after reaching trailing stop level. I exited half of the remaining shares for a gain of 2.64%. Next day, it gapped up, took a profit target, and then we went down, and then the next day we were way down, but then we recovered, closed above the 50, kept me in the trade. The next day barely closed above the 50, and then here on the 18th, we closed below the 50-day moving average. What did I have to do? I had the remaining shares, I had to take a loss of 3.77%. Then the next day it went up, and then it gapped way up. I was like, shoot. Well, I had to follow my rules. And now I'm like, oh, I'm glad I followed my rules. But the key point about this particular trade, it's the value of scaling out, taking the partial profits, and the value of going into trailing stop mode. So if we revisit this trade, look, I hit multiple profit targets, profitable profit targets on this particular day. Here, I exited half of the remaining shares because of a close below the previous bar's low, right? And then it went down from there. So was I glad I sold into the strength? Am I glad that I took half? Absolutely. So really just shows you the advantages of what I do and why I do it and why I take these partial profits, why I go into trailing stop mode, because ultimately, if you have a big reversal, you're glad that you sold into that initial strength and you're glad you sold half at profit. So the remaining shares here down 3.77% where I had to exit. XLE, okay. I entered XLE here on the 4th of November at 87.81. Why? This is a combination of a rejection of the high of the order block and a rejection of the 200-day moving average. So that's deep dip buy and order block combination. On this particular day, we went into the order block, yet we closed above it. That's a rejection of the high of the order block. And then we also went below the 200-day moving average and closed above it, okay? So dual entry signals. So I entered 87.81. I placed my emergency stop, as always, 2 ATRs below. My end of bar stop on this trade is simply a close below the black line, close below the 200-day moving average, right? I always want to keep my end of bar stop close, which I did, okay? And I placed my 1.5 ATR trailing stop level above, and it just took right off. Boom, profit targets, multiple. Next day, multiple profit targets. Next day, multiple profit targets. Got to trailing stop level. Next day, multiple profit targets. Next day, multiple profit targets. And then here we have our first close below a previous bar's low after reaching trailing stop level. I took off half for a gain of 3.25%. And then the next day, up again, profit targets. Next day, up again, huge, multiple profit targets. Now, at this point, on this particular day, we got to a level of 65 RSI or higher. And when that happens, in the future, if I have a close below the 5 EMA, this blue line here, this thin blue line, what do? I got out. This happened, I get out. This happened the very next day. After being at 65 RSI or higher, if I have a close below the 5 EMA, I get out. So I got out and completely exited the trade there for a gain of 3.5%. And you can see from that point, it attempted to rally a couple times, but it is lower than that. So I exited the full trade on XLE and the remaining shares for a gain of 3.5%. And then Costco, another good example of why taking partial profits and going into trailing stop mode is such a good idea. So I got into Costco here on the 29th of October at 9:11. It rejected a halfway. See the green line I have here? Well, this green line, if we go back in time, we have this up bar here. If you have an up bar, halfway of that up bar should provide you some kind of support. Well, that's what happened. I waited for it. It broke market structure, came down, rejected that midpoint there, that green line, 908.80. I entered 911, placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this green line at 108. Next day, we go up, profit targets. Next day, down. Next day, up big, multiple profit targets. Next day, up again, multiple profit targets. I'm also in trailing stop mode at that point. And then here, on the 6th of November, we have our first close below a previous bar's low. After reaching trailing stop level, I took off half of the remaining shares that I had for a gain of 1.36%. Next day up, profit target, and then down, and then sideways, and then a profit target. And then here on the 18th, we had a big sell-off that obviously closed below my midpoint line there of 908.80. So I had to take a loss on that particular trade for a loss of 1.75%. But again, do you see the value in taking the profits when you have them? Do you see the value of exiting half of the entire position in trailing stop mode, right? If I hadn't done any of this, my loss really would have been 1.75%, but it was not 1.75% all in all net net because of taking the partial profits going into trailing stop mode. So this is why I incorporate all these rules into my trading. This is what I do myself. This is what I teach all of my students that I teach are all these rules. So Costco minus 1.75% on the remaining shares. So a recap of the closed positions: RBLX loss of 4.79%, Netflix remaining shares loss of 3.77, XLE remaining shares gain of 3.5, and Costco the remaining shares loss of 1.75. So those are all the open and closed daily positions. Now let's take a look at the 2 weekly positions that I have. In addition to trading daily charts, I also like to trade weekly charts. So every bar here is 1 week. And so weekly bars close on a Friday, so I make my decision on Friday afternoon. So this has been a really great long-term trade on XLV. I took this trade back on 8/8/2025. And again, this is a combination of a rejection of the order block, the rejection of the green box, right? Went in, closed above, and combination of also rejecting the orange line. The orange line is a deep dip buy. That's the 300-week moving average. So I waited and waited. If you've been listening to this podcast, you saw for weeks previous that I said, if it gets down here into this smart money area or this order block area and rejects that major moving average, that's my entry. Well, it's exactly what happened. So I entered at 130.07 on 8/8/25. I placed my emergency stop 2 ATRs below. My end of bar stop is simply a close below this this orange line. Placed my 1.5 ATR trailing stop level above, and let's see what happened to the trade. Next week, took off immediately. It's amazing how many times when you're patient and you wait for rejection of the order block or rejection of the major moving average, how it moves up. That's exactly what happened. So the next week, boom, moved up. Multiple profit targets right away. Next week, another profit target and got to trailing stop level. Then we moved sideways for about a month. And then here on the 26th, we had our first close below a previous bar's low after reaching trailing stop level. What do? I get out of half the remaining shares, and I got out of half for a gain of 3.99%. Next week, took off again, sold multiple profit targets into that strength. Then we moved sideways, and then we moved up, profit target here, couple weeks sideways. Week before last, up massive, right? Up massive, multiple profit targets. And then this week, another profit target. Now, we're at a 68.76 RSI. So right now, if we close below this 5 EMA, the thin blue line, I will be completely out of the trade. In addition to that, next week, if we reject the 70 RSI, meaning that we go above the 70 and close below it, I will exit half of the shares that I have at that point immediately, right? These are just other rules. So when you get up into the 70 RSI levels or you get to the 65 RSI levels, then I have other rules that come in to get me out of the trade. All right. And so again, this is what I use. This is what I teach all of my students, all of these rules. But this particular trade doing outstanding, the remaining shares up 15.91%. And again, combination of rejection at the top of the order block, combination of rejection of the major moving average, starting with a very good risk to reward ratio. I didn't know it was going to do this, but you have to set yourself up so that you have the potential for this to happen, and this did happen. So gain of 15.91% on the remaining shares of XLV. And then last one, everybody, thankfully, on the weekly UUP, I entered UUP here all the way back on 7/11/2025. Again, 2 major primary signals: rejection of the high of the order block, the bar before was in the order block, closed above it. There's one. And we also had a close under and over the 200-day moving average, which is the black line. Entered 27.21. Place my emergency stop as always, 2 ATRs below. My end of bar stop is simply a close below the 200-day moving average. I placed my trailing stop level 1.5 ATRs above. Next week, took off, profit target. Next week, down, nothing. Next week, up, multiple profit targets, and got to trailing stop level. Then we had a week down, and then here we have our first close below a previous bar's low after reaching trailing stop level. I got out, locked in half for a gain of 0.51%. Then we basically moved sideways for a month, but we never closed below the 200-day here on this week. Pretty scary, but it recovered, closed back above, kept me in the trade. Thankfully, next week up, profit targets. Next week, nothing. Next week up, multiple profit targets. Couple weeks of sideways motion. Next week up, profit targets, right? And then this last week, I hit 2 profit targets. Now, we're at a 62.76 RSI. So the 5 EMA is not coming into play yet. However, if we move up at all next week, we will get to a 65. And if we do, now that 5 EMA will come into play. So the remaining shares that I have on UUP, the dollar, up 4.12%, which is a big, big move on a currency. So recap on the 2 open trades on the weekly, XLV up 15.91% and UUP up 4.12%. So woof, that was a lot of trades to go through, everybody. I hope you found that helpful. Give you an idea of how I enter these trades, why I enter these trades, how I'm managing them. And if that was helpful and you did learn something, I really would appreciate it if you could hit the thumbs up button or subscribe to the channel. Both would be great, and I would appreciate it. So, okay, so those are all the trades. And before we get on to next week's trades, let's quickly talk a little bit about trader psychology, okay? Okay, this is from my good friend Steve Burns. Steve Burns, very famous trader, very famous author, and just all around great guy, very smart guy. And I would really suggest that you go to Amazon, read any of his books. He writes the best trading books. And I was lucky enough to write the foreword for one of his books, Moving Averages 101, which is a great book. You should really read that. And follow Steve at S. Joseph Burns over on Twitter, has great information. So when I read his post here, you might say, what does that have to do with trading psychology? Well, it has a lot to do with trading psychology, and I'll explain why. So Steve says, amateurs open trading in the stock market in the morning, professionals close it in the afternoon trading. So I make all of my decisions whether to get in or to get out, unless it's my emergency stop. If it hits my emergency stop, I get out regardless of the time of day. But other than that, I wait until the end of the day to make my buying decisions and make my selling decisions. Okay. And this is exactly what Steve is saying here. Amateurs open trading in the stock market in the morning, professionals close it in the afternoon. I'm a professional stock trader, so I wait until the end of the day. Now, I'm not moving the market, but the professionals are moving the market. The large financial institutions are dealing with the most money. They have the best information. They have the smartest people, and they have the best technology. And so at the end of the day, they come in with all the advantages that they have and make decisions in that last hour. And so when the trade is or when a market closes at the end of the day, the large financials came in and moved that up or down at the end of the day. So really, this is just a long way of saying, wait until the closing price to make your buying and selling decisions. That's what I do, because the people that really know what's going on, that have all the advantages, they are moving the price in that direction. It is the most valid price to make your buying and selling decisions from. So that is why I wait, and that's what I suggest to traders and my students, if you're going to buy or sell something, it should be based on the most valid price, right? Not on the opening price, which is amateurs. Do I want to follow amateurs? No, I want to follow professionals. So the reason this has to do with trader psychology, everyone, is that it's patience. Patience to wait for the closing price to make your decision. You know, people say, oh, it's at 200 right now. That's probably the place to buy. I'm like, yeah, but the market's not closed, right? At the end of the day, the professionals may move this in a different direction. It is right now, but it's not valid, right? So, you know, this is just a suggestion from me because this is what I do. I wait until the end of the day to really decide what I'm going to do based upon what the professionals are telling me. And this has to do with trading psychology because it's patience, waiting until the end of the day to have the professionals clarify or support your thesis. And if it closes under, then they did not support your thesis, right? So wait until the end of the day to decide and let the professionals tell you whether a level is valid or not. And that is patience and waiting. And I know it can be tough, but overall, I think it will reward you. It has rewarded me greatly to wait for the end of the day. So thank you very much, Steve Burns. I learned this from Steve Burns years ago, and it has served me well. And so that's why I'm just putting it out there for you as well. Okay. So thanks, Steve. Appreciate the good post. And now let's take a look at the potential trades for next week. I think I have some good ones here. I don't have a lot of them. I only have 7. But I do want to point out something first. So these 7 potential setups for next week, it is possible that all 7 of these will trigger on Monday. Does that mean I will take all 7 trades? No. Even if all 7 of these trigger, I'm still going to narrow it down to the best one. And how do I do that? Well, I give each trade a score, like a quality score. For example, if AMD has 1 signal, it gets 1 point. If Amazon has 2 signals, it gets 2 points. Which one do you think I would pick? I'd pick the one that has the highest score. Maybe Google has 3 signals. Okay, that's the one I'm going to focus on. So I take into account how many signals, how many confluences of signals are happening at the same time. What is the risk to reward ratio? And it's tricky because sometimes you can have like 3 or 4 really good signals, but the risk to reward ratio is not good. So then I may have to pass on that one, right? So, and then I also look at the larger time frame. If I'm trading the daily, I look for the weekly to see if I can get some clues from the weekly. And then I also look at the relative strength of a stock. Maybe the market's down across the board, but this one's up. Well, that's called the relative strength. That would get an extra bonus point. See what I mean? So the devil's in the details on this trading. Then this is how I score my entries, and this is what I teach my students. And by the way, if you're interested, I do teach students all over the world, and I do a very intensive course. It's a 20-hour course, and it's one-on-one. It's just you and me. We do 2 hours a week for 10 weeks. And it's an invaluable course. I have taught so many great traders around the world. I have taught people from absolute beginners. I teach and consult with hedge funds at the very top level and everywhere in between. So if you want to learn the skill of trading, I'm very happy to have you as my student. We'll spend 2 hours a week. I'll teach you all the signals. I'll teach you all the nuances, and you will really have a skill that you can learn the rest of your life. So if you're interested, just send me an email. The email's in the link of this YouTube video. I'll get back to you. I usually like to set up just a free initial kind of get to know you call so I can learn more about you and your trading experience and your trading goals and your challenges. It's also a good time for you to ask me any questions about the format of the course. And it's not a sales call. It's just a get to know you call just to see if we're a good fit. Okay. And so, yeah, please send me an email. Let's start the conversation. I'll teach you everything that I know. And trust me, you will have a great skill that you can go into next year with and that you can use the rest of your life. So The 20-hour course, great. Obviously, it's the best. As an alternative, I have a really good Udemy, online Udemy video course where I teach you the deep dip buy strategy. It's 9.5 hours of video. It's a really great course. I've sold so many of those around the world. It's like a 4.85 stars on that. And so if you're interested in that, it's a very affordable way. It's somewhere between $30 and $50 that you can start with that course, right? So, and the link for that is in the Udemy link for that is in the description of the YouTube channel. So, okay, there's my little housekeeping plug, but keep it in mind, love to have you as a student. And let's get on to potentials for next week. So AMD. All right, well, AMD had a huge move up, and then obviously, like most tech stocks, it has come down. Now, this is a little bit interesting setup that doesn't happen a lot, but it did catch my eye last night when I was going through. Now, normally you hear me talk about order blocks, deep dip buys. Okay, this is not an order block, but it is a bit of a deep dip buy. But so there's an old saying that previous resistance now becomes support. Well, this level here was previous resistance. We got up to it, we came back down, and then we blasted through it. And previous resistance now becomes support. So once you got above this level, now this level is support. So we take this previous high here, the level of support, since we're above it, and we move it forward. If we come back down to this previous resistance, which is now support, we'll probably have support, right? But in addition, what really caught my eye is that this previous high support now dovetails very nicely with this 100-day moving average, the red line. So keying off a major moving average just by itself, it's not a bad idea. But again, looking for the confluences. Well, this red line, the 100-day moving average, dovetails perfectly with this previous high, which is going to most likely act as some support. It doesn't have to. But long story short, what I'm looking for is AMD to come down next week and reject this 100-day moving average. And if it rejects that, it will have also rejected the previous resistance. Okay, so that's what I'm looking for. And we're at a 37.26 RSI. So if we come down further, there's a chance that we will reject the 30 RSI and reject the 100-day moving average and test that previous support. Doesn't mean it has to work, but there's a lot, I can just, from experience, I can just tell there's a lot of support from different factors, RSI, previous highs, 100-day moving average right here. So basically, in a nutshell, I'm looking for a rejection of the 100-day moving average, either a bounce, an intraday rejection, or a close under, close over for a potential entry. Amazon. Okay. Yesterday morning, I thought Amazon was going to get to kind of my favorite setup. Rejection of the high of the order block and a 200-day moving average, the black line that lives inside the order block. Well, we didn't quite get there. Now, we rejected the 250-day moving average, the purple line. That by itself legit for sure. But in the morning, it was so close, I thought, oh, this is going to be great. We're going to reject the 200, potentially reject the 200, and potentially reject the top of the order block. So I didn't take this trade because at the end of the day, I was like, oh, we never really did reject it. So next week, this may just take off from here, and I hope it does for people that own Amazon. So I didn't take this trade, but next week, for some reason, if we do come down, if the market heads down lower and we reject the top of the order block and reject the 200-day moving average, I would certainly look and consider taking that trade. Also, there's the 300-day moving average, the orange line inside the order block. That would be another level. So I'm going to watch Amazon closely next week for rejection of the 200 and or the high of the order block, or a rejection of the 300-day moving average, or obviously a rejection of the low of the order block. 200, 300, or the low of the order block is what I would look for. Google. Okay, Google is, I don't have a specific entry here, but as I was going through the charts last night, there's something very striking about this chart, and I thought it would be a good teaching experience. So I studied one-on-one with Dr. Alexander Elder. And Dr. Alexander Elder is a big fan of double bottoms with MACD divergences or shorting double tops with bearish MACD divergences. And at the moment, Google, it's striking the potential for a bearish MACD divergence. So let me point this out to you. Let's take a look at this high here. We have a high here, and let's look at the green MACD bars, okay? The farther these green bars are, or the higher these green bars, all that means is the momentum's just very, very strong, okay? So we have a high, and we have high MACD bars, which makes sense. But now look, we are now higher here than we are over here. Would you agree? We're higher here than we are over here. But look, we have no green bars whatsoever. This is called a double top with a bearish divergence. All it means is that this last move up here in price, yes, it went up. But from a MACD perspective, you're running out of buyers, essentially is what that's telling you. When you have a double top bearish MACD divergence, it means you are running out of buyers. I mean, let's look at the slope of the line here. Definitely going up. But when you look at the MACD, definitely going down. Okay. This indicates to me that if you run out of buyers, you go down. If you run out of sellers, you go up. So I'm going to be looking for a short on Google. I don't know what that's going to look like. It could potentially be a bearish baby. That would certainly be some kind of potential for me to get into. If you want to learn more about babies, abandoned babies, island reversals, go to my excuse me, go to my YouTube channel, and there's a video there that explains in details. But essentially, that would be a gap up followed by a gap down. At that point, especially in light and context of this double top bearish divergence, I would look for a potential short. But it hasn't happened yet. I'm not going to short it until something happens. But this is such a striking double top bearish divergence. Again, price is going up, MACD is going down. Let's look at the RSI. Look at the RSI reading here. Again, at this top, we have this RSI reading. Now we are higher, RSI is way down here. So all the momentum indicators are showing that this is slowing. And if that happens, I mean, if you're running out of buyers, that's why I'm looking for a potential short. But I don't know what the short's going to look like, unfortunately. It could be a rejection of the 70 RSI. It could be a rejection of the third ATR channel. It could be a bearish abandoned baby. But I just wanted to point out to you, when you have prices moving up and MACD moving down and RSI moving down with divergences, means that you're running out of sellers and a pullback should be expected. Okay, let's go to Lockheed Martin, LMT. Okay, LMT, you see I have a green order block here. You can see inside the order block, I had marked a level. Okay, why did I mark the level? A little hard to see, but we have a V2 here. Bar 1, bar 2 goes under bar 1's low, bar 3 closes above bar 1's close. Halfway of the washout bar, or bar 2, is going to be the level 448.90. In addition to that, we have an order block. And so it always amazes me. Look at that, everybody. We came down, didn't take this trade, but look, we came down right to that level that I marked. And then it took off. Okay, great. Now it seems like we're heading down a little bit. So I'm going to be watching Lockheed Martin for a move down and rejection either of the high of the order block at 452.22 or a rejection of that midpoint line for 48.90 or a rejection of the bottom of the order block at 447.01. So those are my three levels that I'm looking for rejection for. I just spoke about double tops, bearish divergences. Well, I can just tell from Lockheed Martin, if we come down and we test this low, we will have a double bottom with a bullish divergence, because look at the low here, how deep the red bars are. Then we rally into green. I can just tell you right off the bat. I mean, here, I can just show you. If we were to come down on Monday and test this low, look how shallow this red bar is. Again, if we have a low here with deep red and then we rally and then we come down and we only have a little red, this is the opposite of Google. It means we're running out of sellers. And if you're running out of sellers, generally you can expect a rally. So that's what I'm going to be looking for. A rejection of the high of the order block, 452.21, rejection of the midpoint or the midpoint line that I drew, 448.90, a rejection of the low of the order block, 446.90, in the context of the, looks like the double bottom bullish divergence that's setting up. Netflix is a very, very good example of a double bottom bullish divergence. Let's look at the low, very deep red MACD bars. We rally, yes, green. Are we lower here than we are here? We certainly are. But let's look at the MACD bars. Are these, is this, even though we're lower here, is this deeper than over here? No. It's much more shallow, shorter bars than here. This is a double bottom bullish divergence right now, right this second. Now, you see this line here, this trend line. Well, this is a megaphone trend line. If you have a low, a swing low, and you connect it to another swing low, and you connect that line and it goes out into space, if and when you ever get to that level, generally more times than not, you can expect a bounce there. Well, technically this was a legitimate entry on Friday because we rejected that megaphone trend line. But what I'm going to be waiting for is this orange line here. This is a deep dip buy. This is a 300-day moving average. So next week, if we reject this 300-day moving average, I very likely will take the trade. One, because it's a 300-day moving average. Two, because we have double bottom bullish divergences happening here as well. And three, we have this megaphone trend line where the price has come down and made that third point. So kind of this area right in here, in my opinion, is the area where we should expect the bounce. But I could be wrong. I'm wrong all the time. So I have to wait for, basically what I'm doing, I'm waiting for a rejection of this 300-day moving average. 300 is at 103.29. And then that'd be my line in the sand. If it keeps closing above it, great. I'll take profit targets, go into trailing stop mode. If it closes below even a penny, I'm simply out. Palantir, PLTR. Well, everybody just had to have it up here. Now nobody wants it. When nobody wants something, that's generally what I'm looking to buy. For one, we are in a green order block. Has not rejected the high, has not rejected the low. So can I take a trade inside the order block? I can if I have a legitimate line, like I've shown you many times there where I drew the midpoint, but there is no midpoint to the left that I can key off of. However, look, we're at a 33.85 RSI. Remember I was telling you about it, under 30, over 30 is a legitimate level just by itself. But an under 30, over 30 inside a bullish order block is much stronger. So really what I'm looking for next week on Palantir would be some kind of rejection of the 30 RSI or a rejection of the bottom of the order block, potentially at 148.07. All right, last one, everybody. TMUS, T-Mobile. Okay, so T-Mobile is interesting here. we rejected the bottom of the order block, moved up nicely. Well, now we've come back into the order block. Next week, if we reject the bottom of the order block, that would be legitimate. Okay, just that by itself, and that's like 205.85. But the one thing that I really kind of wanted to show you on this chart, again, megaphone trend line. Here we have a low, here we have another low. Boom, we connect. This megaphone trend line did not hold, but then you can see here on the 11th, we jumped back above the trend line. So we broke this downward trend line to the upside. Now, if you break a trend line to the upside, a lot of times it will come back to that trend line and test it. Now it's above the trend line. Now it will come back and test the trend line. Well, if it does come back and test the trend line and hold the trend line and then bounce back into the order block, would be legit. Look, just a rejection of the low of the order block is legit. But big picture contextually, when I see this trend line, if it has a back test of the trend line, that's an additional advantage and support for a bullish thesis. So just to make it simple, I'm looking for rejection of the bottom of this order block. If it bounces, if it tests that trend line, holds and bounces above, that would be even better. All right. So listen, everybody, I hope this was helpful for you. If it was, I'd appreciate if you hit the thumbs up button. I hope you have a good weekend. We have Thanksgiving next week. Be careful. This market obviously is a little bit crazy, right? So let's get our plans together. Let's follow our plans and stick to your plans. But, I always like to leave everybody off with, please try to go out and do something nice for somebody today. If you do one nice thing for another human being every day, it would just make the world a better place if we could all do that. If you could go out, try to do one nice act of kindness for an animal each day, that would be fantastic. They appreciate acts of kindness just like we do. And, we like it when somebody helps us with something or does an act of kindness for us. So why not go out and do that for other people and animals as well? So if you have any questions about anything I mentioned here today, I know it's been a long podcast, and if you've made it all the way to the end, thank you for that. Appreciate that. But if you have any comments, questions, put them in the comment section. I'll do my best to answer them. And yeah, thanks a lot, everybody. Have a great weekend, and be safe and be good to yourself. All right. God willing, I'll see you next week. Take care, everyone. Thanks a lot. Bye-bye.
U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.